Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this Tuesday, September 27. So a pretty interesting price action day across the dollar index, yields, the S&P 500. And just when we think that the S&P 500 is getting a little bit of a reprieve and a bounce due to the dollar pulling back, the markets check us again, and they basically reversed all of the gains. But let's go to the intraday action for the S&P 500. So here we have the 10-minute chart, and this is where we opened in the pre-market and gapped up in the pre-market trading. So it was a massive gap up from basically 364 all the way to a high of 368. So over a $4 move on the spiders. And it looked like the markets were off to their races. But yet again, the dollar had other plans for the market. And this rally looked like it's starting to build up steam until you started getting these nasty heavy reversal candles. And when you factored in that these reversal candles came directly on the back of the dollar, that will basically give us a clear picture as to why the market started selling off. So this is where the markets basically opened. Dollar gap down last night. So in the overnight futures, the S&P was actually catching a lot of momentum and steam as the dollar started to break down. And then this was this morning around 7:50 a.m. The dollar started to climb, had a little bit of a pullback, which is why the S&P rallied. And then the dollar just started rallying and made new intraday highs, taking out some of the highs from yesterday, not the complete high, but nonetheless this major pivot over here. So clearly the dollar is still continuing to see massive upside strength. And whenever you see a gap from an asset class that is very strong in a raging bull market, you have to be very vigilant, because the likelihood of the price action retracing and filling that technical level is highly probable. Now, do I think the dollar should pull back? I still absolutely do think the dollar should pull back. But the fact that the intraday rally is exactly why the spiders started falling, it's pretty much a mirror image, just shows you how correlated the markets are, and they will not catch a bid unless the markets start to fall. And the interesting thing about the dollar is if we flip to the daily chart on the dollar was looking to confirm a breakout outside of this parallel channel, but you failed to close above yesterday's high. Even though you wick high, even though you did make a closing high compared to yesterday's high, you didn't take out the wick, so there's no confirmation there. Now, I'm still in the camp. If you look simply at a weekly chart, the dollar is at major resistance. You have this upsloping parallel channel, which you're tagging and trying to break out of on a weekly basis, but you have failed to do that. You've also failed to do it on a daily basis at this point in time. And then you even have this longer symmetrical parallel channel, which has kept you in check for multi-years, which you've tagged to a T. So I still think that the dollar should see some inevitable downside, just due to the fact that it is extended on all time frames. It's extended on the major, which is the monthly. It's extended on the intermediate, which is the weekly, and it is also extended on the daily. So when you have a market that is extended on all major time frames, it puts into the probabilities that we should see somewhat of a pullback in the near term. Now, I'm not saying that the dollar is going to collapse outright, but it should see somewhat of a pullback, and I still have the same thesis as to that. Once we see that pullback, we should start to see a bounce in the S&P. And this was a nasty sell in the spiders, just completely gave up all the gains. This is what's called a famous gap and then crack. So not very healthy for the markets to lose all the momentum. But that didn't stop us from accumulating and still continuing to be more net long, as we are oversold in the short term. And simply, when you look at this double bottom period, when you factor in that I do believe inflation is going to start to come down. There's many inflationary assets that are signaling that we've reached peak inflation, short-term peak inflation. I do believe that there is the potential that we could have numerous bouts of inflation over the next 2 to 3 years before we truly get it under control. But nonetheless, the only thing that would really wipe out inflation completely is a deflationary bust. But if we don't have that deflationary bust, and it's a lot of, choppy price action, sideways price action. We could see the inflationary pressures continuing to go up, go down, go up, go down, which certainly would be massive headwinds for the market. But needless to say, this daily chart is more oversold now than it was yesterday. So that does even put into the probabilities that we should see a bounce. Now, the short-term positive for the S&P daily is that you still closed inside of Friday's wick low. So that is short-term bullish despite having massive selling. This kind of distribution formation is kind of shaking out those weak hands. And the interesting thing is that if we actually look at the SPX, we did pierce the lows, the June lows. So markets are always looking for a series of lower lows or higher highs. Whenever you pierce a major pivot low and make a new low, which is what we did today, it opens up the probabilities that the markets can now start to look to potentially make a new higher high. Now, I'm not saying they're going to make a new higher high, but that's what the price action looks for. Often, people, once you break a key support zone like here, people start piling on the short trade thinking it's going to go much, much lower. But that is kind of the market's way of capturing in the bears before they rip it up and give a little bit of a bull market or a little bit of a bull rally reprieve. So I still think at the minimum we fill this technical gap at 37.55. You still have more technical downside on the head and shoulders formation, which we have triggered. But needless to say, we are now starting to potentially curl up on the RSI. You are in this oversold category. You can see that even on the June lows here, we weren't as oversold as we were there. We were as oversold basically on that initial decline. But nonetheless, this type of degree and sell-off is pretty powerful. If we simply throw up a measuring tool, you can see that this degree of a decline was about 59 degrees, whereas this degree of decline is about 66 degrees. So a sharper degree decline. Let's just measure this one. This was your more oversold. This was a 77 degrees. So we're not at the highest level of degree, but we're also not at the lowest. So it does favor that pullback, especially since yields have also been parabolic. Taking a look at the US 2-year yield, just to give you perspective as to why the dollar rallied, simply throw on this. We have also had a failed attempt at a breakout out of this parallel channel, which should be short-term bullish for the markets. When you have a power move of 13 upside days in a row, I think the bond market has reached maximum peak hawkishness in the short term at the minimum, and I do think we see somewhat of a pullback in yield. Now, we do have Powell speaking tomorrow, so that could be certainly an event that moves the markets. Also taking a look at the longer term yields, it was really interesting to see the short end yield pull back, but when you look at the long end, the 10-year, it actually started to rally up a little bit and actually closed higher. So what does that mean? Well, it means that the long end rates are potentially trying to force that yield curve to uninvert, and that would be a lot healthier for the economy. Now, we have sustained a yield curve inversion for quite some time, and even if we look at the US 20-year yield, which is what we've been playing via the bond market, 20-year yield did have also another positive day today, and that is certainly an interesting factor when you factor in that the short end yields finished lower, but the longer term yields finished higher. So that is actually a short-term positive sign for the markets. Believe it or not, yes, it is higher rates. It does put more liquidity pressures on companies to borrow money, but needless to say, we really do want to see that yield curve uninvert where the long end treasuries provide more yield compared to the short end. So the 20-year bond certainly has hit resistance. It has gone parabolic in my opinion, which is why we continue to add to our UBT play. So you can see that UBT has had a significant decline, basically losing a lot of its momentum. But look at this drop in the bond market. I mean, that is a substantial level. Now, we'll continue to add. There is a key gap fill coming up right around here at 2410, which I will look to accumulate more of this UBT play in the event that yields continue to go high. I still think bonds are going to prove to be an exceptional trade and investment moving forward, just due to the parabolic nature of yields and how oversold bonds are. Let's take a look at oil. The WTI chart is really, really intriguing. if we simply look at the weekly chart here, I just want to draw this broadening formation, which we were watching for quite some time, even before this whole Russia-Ukraine war spike. So this was your resistance, which you've clearly broken. Now you're starting to come into some major support. So if we take a look at that, you can see that you have a major pivot zone over here, major pivot here, and then let me just adjust that trend line a little bit, connects to this pivot, and look what you're tagging today. And then when you also throw in an additional trend line, you can see that this pivot high over here is acting as support once again. So clearly with a massive move down in oil, I do think that we can get a likely bounce. Where I see the upside target to is if we simply draw a trend line down, I still think oil can actually float all the way up over the coming sessions to maybe this $85 barrel. So that's kind of what we're positioned for. We have been accumulating UCO, which is a double leverage oil play. It's a very starter position, so in the event that oil does go lower, we'll be able to accumulate even more. Taking a look at natural gas has had a little bit of a down day, but it's still holding inside of that reversal bottoming kind of formation over here. Now, do I think that natural gas still can go lower? I absolutely do. You are coming into some support. I would have preferred to see not see this reversal. If natural gas came right down into our support, I most likely would have been a buyer net long. But now, considering you've had one reversal candle here and it looks to be potentially like you're turning positive, that might be a little bit of a problem at our support level. May have to just pick a little bit of a lower level if natural gas continues to float down. Let's take a look at gold. Gold, once again, pretty much pulling back off of the highs. Gold finished relatively positive on the day, just slightly positive, you can see here, but really not really a big bounce for gold just due to the strength in the dollar. And you can see that the gold was a lot higher on the day as the dollar was falling, but considering the dollar had a late rally, it pushed gold substantially down. Let's take a look at silver. Silver also was under a little bit of pressure, gave back all of those gains. So the question is for silver, we don't really want to see a bear flag start to form. It's too early to tell what type of pattern this is. Needless to say, silver will start to perform if the dollar starts to pull back. And the interesting pattern I'm watching on silver is you are forming a little bit of this inverse head and shoulders formation here. If this can start to curl up and form a right shoulder, that could be a short-term, very, very bullish signal, which would imply a substantial amount of upside. I mean, just simply taking this high to that low, so that's 1740.50 to about 2050. So that's a $2.50 move to the breakout line. So you would be looking at basically a move to 22.28, give or take. So that would be a substantial climb in silver. It certainly would light a fire under the miners, and that would be something healthy. Silver is still extremely depressed. You still are technically holding this major bull flag pattern. You're at support, you're oversold, and with a dollar that has surged to extreme highs, practically gone parabolic, it's still impressive that you're potentially seeing this bottoming formation forming in the precious metal sector, or at least silver. Let's take a look at the Dow. The Dow Jones is an interesting and intriguing chart. We haven't really looked at it. I don't really follow the Dow much in our daily analysis videos. I do look at it every day as a trader. The reason the Dow is so important is it gives us a barometer of the overall economy. The Dow is composed of many of the industrials and transports, which arguably is what keeps our economy functioning and going at a high degree. So if the Dow is positive when the rest of the market is weak and even the dollar is strong and yields are surging, that is an uber bullish signal to me as an investor and trader. The Dow actually closed up 1.28%. And the interesting thing is that it was a mixed market session today. Despite the dollar up, testing the new highs and closing at a new high, as well as yields breaking out again, at least on the longer term yields, the fact that the Dow is still positive just shows you that there is some potential relative strength coming in the markets, and that the likely scenario for a bounce is starting to improve drastically. And you can see that this downsloping parallel channel is acting as support for the Dow. You did have a pop in Ryder Systems for a buyout, which certainly helps the transports get a lift. But the Dow, if the Dow gets a little bit of a run, you can bet that the S&P and the rest of the markets are slowly going to follow behind. So the Dow certainly is showing a little bit of strength, and that is certainly healthy for the overall barometer of the economy. Now, if the Dow continues to go lower, you do have this down sloping trend line. This is kind of your breakout zone before your massive move up in 2021. You also have these massive pivot supports over here. So tons of support approaching. I may consider buying the Dow if we start to pierce this channel and go to the lower end. But needless to say, it is looking like a little bit of relative strength showing in the transport sector, which is certainly healthy to see and why I think we're going to get a bounce. But overall, it was a mixed market session. We did have some stocks up like Apple and Tesla and Nvidia. Those are some of your mega caps that were up on the day, as opposed to Meta, Amazon, Microsoft, Google. Those are down on the day. So that really cancels each other out because Apple's such a massive, massive market cap. And then in terms of the sectors, you did have financials down, energy up, materials up, industrials down, consumer staples down, utilities down, healthcare down, real estate down. Let's just take a look at the XLU just to see where that has traded. So remember when we were looking at the XLU and we tagged that resistance? So now that let me just drop that down a little bit. So when we tagged that resistance up here, we were calling for a massive decline in the S&P, and that's certainly what we got. But look at this massive sell-off. You're on a 1, 2, 3, 4, 5, 6 days down on the utilities. That is a sheer panic drop. And now you're at a little bit of support in an oversold state. And I do think that we can potentially start to see utilities bounce, which usually means that the markets are also likely to bounce. Let's take a look at McDonald's because we are day trading that one and holding it overnight. So McDonald's is an intriguing chart. Let's flip to the weekly chart, shall we? So McDonald's is intriguing because you are coming into this support. You can see this down sloping trend line over here connecting your pivot high. All of these major pivots, 1, 2, 3, 4, 5, 6 pivots, boom, boom, boom. And then you also have this upsloping trend line, major pivot to intersecting with this wick, major pivot, and you're almost tagging that level to a T. You've had a beautiful 3-bar surge to a low, which is what I think has happened. And you're also on a 1, 2, 3, 4, 5, 6 days of downside in a row. So day trading, we are at support. I do like McDonald's for a potential bounce. It is a lot safer. You're not going to see a drastic decline, which is why I'm comfortable holding it overnight. Needless to say, let's take a look at Bitcoin. BTC was totally rejected basically at this downsloping trend line. So it's just showing you the power of this longer term downsloping trend. BTC hitting it and reversing. That is not a positive sign for Bitcoin, considering that it is once again back under this yellow 2017 pivot high. You're just kind of on borrowed time now for Bitcoin. It does seem that the more times it fails to get above this level and close and confirm, the likelihood of it breaking lower and confirming is increasing each day. Now you are still inside of this bottoming tail, so you have to respect that. But needless to say, the fact that you've had 1, 2, 3, 4, 5, 6, 7, 8 basically attempts at getting higher, and you've reversed significantly on those 2 major attempts. So that short term is not a real healthy sign for the markets. But I still think that these markets can get a bid once that US dollar starts to cool off. And we'll just have to see what Powell says tomorrow. But I do think that being long at this point does provide a little bit of a better risk to reward ratio. So that's just kind of where my head is at. I do think that market bounce is likely to come, and when it does, we'll certainly be poised and ready to profit from it. So thank you all for being members. Please give this video a big